you're back here on Mining Stock Daily. We are going to kick off the end of Monday here with some market commentary. Happy to welcome in a good friend of mine, good friend of yours, Mr. Rob Sinn, Mr. CEOTechnician Rob. Welcome back to the podcast. It's been a little bit.
Hey, Trevor. Yes, it has been 2 or 3 months, and this is the first time I'm doing your video format. So you got to see my face while I speak.
That's right. But however, it doesn't do you justice because you don't get the full extent. You just get the broad shoulders.
You don't get the full expanse of me. Yeah.
The system just isn't big enough. Rob, let's kind of talk into let's dive into some macro here. We had some jobs data come out last week, Thursday, ADP. I don't think anybody ever paid any attention as much as they did to ADP data until they did this past Thursday, where payrolls came in more than double the expectations. Bond yields crashed. I mean, people were selling off bonds, so the yields went higher. The equity market fell, the dollar fell, gold and precious metals fell. I mean, it was kind of an ugly day here. It gave a little bit of ammunition for that Fed to say we're going to continue to raise rates, and we knew it was going to happen. And then Friday, the non-farm payrolls came in. I think a lot more people give more clout to the NFPs, and that showed some more cracks in the system. However, there's still a little bit lost. People are trying to find a reason to buy the dips in the general market. I guess given the extent of those 2 days, how are you approaching these markets and that data and what you witnessed?
Well, yeah, there's a lot to talk about there. The way I approached the market Friday morning was being long gold miners, being long gold, like immediately after the print, and then getting long, some S&P futures, and that worked very well. I mean, I think the print coming in at 209 with, revisions to the prior 2 months totaling minus 110,000. That's a Goldilocks, number for stocks. It's a good print for gold too, because it shows that the labor market is rebalancing. It may still be tight, but it's not super overheated, right? So I think it was a perfect print for stocks, and certainly, we saw S&Ps trading around 44.35, 44.40 on the futures, ramped over 44.70 throughout the session. And gold, hanging on above 1930, but still having trouble getting back above 1940. And that's something, we could talk about as well, the technical, picture for gold and silver.
Yeah. It's interesting. I think I bookmarked a tweet from Steph Pomboy. It was pretty interesting. You can go back to her Twitter account to read this, but she, regarding the NFP, she wrote, "Are we about to go from labor hoarding to labor shedding?" We're starting to see cracks here, obviously, but it's interesting with the NFPs that white collar jobs. Those are those are the industries that are cutting jobs, where blue collar jobs are the ones gaining jobs, along with services, actually, Rob. So, you've been around with a couple cycles, and I've asked previous guests this last week, so I'll ask you. What's really going on here when services, blue collar jobs are gaining momentum while the white collar workforce is it's getting cut. We're seeing more cuts from that. What does that mean for you in a cycle here?
I mean, I feel like it's getting towards the end of the cycle, because when you have the $20 an hour kind of jobs being, quite available, and anybody sort of at the lower end of the pay spectrum can get a job if they want to, even if it's driving for, Lyft or something. But people aspire to higher salaries and higher wages, right? Everybody wants to be paid more. So it's almost impossible to find any level of quality employee for less than $20 an hour now. And even a lot of places are having to pay 25 to 30. And then if you want skilled labor, like a programmer or something, or you're talking $100 an hour, $150 an hour. And so I think we're seeing businesses and sectors of the economy like finance, like big banks, shedding some of the higher paying jobs as they right size their cost structure to this new environment that we're in, where money is no longer completely free. It
Mm-hmm.
costs a little bit. It's not super expensive, but it's definitely not free anymore like it was in 2021. And I think that, if you look at the payrolls, I mean, just look at the chart of non-farm payrolls the last few years. So beginning in late 2020, they started to really surge as the economy picked back up again. We peaked in February of 2022. So this economy is definitely readjusting. We're way, way off the highs in labor and inflation. And it feels to me like things are normalizing again. And it would be interesting to see the CPI print next Wednesday, where, if we think back to last summer, the exact same month of the year, we had that really scary print of 9.1% on CPI that freaked everyone out. Well, that turned out to be a major inflection point in a lot of things. And I believe that next week we're likely to see the CPI print less than 4% for the first time since 2021. And yeah, the Fed may hike one more time here in a couple weeks. I guess it's priced in at this point, but I really think they're done. And they're going to talk a big game. They're going to keep saying more needs to be done on inflation. But if we get to 5.5%, that's the highest Fed funds rate in 2 decades, 3 decades, right? And they'll then be above the headline CPI by more than 150 basis points, and they'll even be above the core CPI then. So the Fed will be in a restrictive monetary policy stance, a very restrictive one. And while the data picture is mixed overall, the trend is down. The trend is down in a lot of the data we see out there across the economy.
Rob, the ultimate battle right now is between the bond market and the equity market. And something's got to give here. Either the bond market isn't right or the equity market isn't right. Given where rates are right now, I tend to believe that the equity market perhaps isn't correct, because there's only about 9 stocks that are cumulatively are carrying about 30% of the market here. That's way too leveraged to a very small amount of equities that are carrying this thing. The 2-year went back over 5 last week. We'll see. It doesn't. So we'll see where that has the 10-year and the 30-year obviously hitting major resistance. It looks like yields want to go higher based on the data. But that means something's got to give in the equity market. Do you have, obviously I'm explaining my reasons for concern in equities. Do you share a similar sentiment?
I'm a technician first and foremost, and while I can talk, fundamentals with, a lot of people, and I can talk macro, and I do think about the, macro. I use technicals first and foremost. The technicals of the stock market environment have improved drastically the last few months. A lot of people were bearish back in April and May, got caught wrong-footed. And I gotta ride the trend here. A lot of stocks continue to set up. We're seeing chart patterns work. Finally, chart patterns that haven't worked well the last year are starting to work again. So it's a question of whether you want to be right or make money. I'd rather make money. But yeah, I mean, if I think about what, we were in March, we had a regional banking crisis. We had one of the largest banks in the world essentially fail and get gobbled up. And now we're in this Goldilocks where we had a Fed speaker, this morning say, quote unquote, I feel like we are on a golden path of avoiding a recession. So it's just like, it's too good to be true almost.
Yeah.
But when is the reality going to hit? I don't know. It's really hard to time it. But it does seem like it's too good to be true. But I mean, as long as it's working, you got to go with what's working, right?
Yeah. All right. Let's talk about the exploration sector here, Rob. You spent some time in Nevada recently, did a couple site visits. You talked about going long gold here, as in the last couple of days. What is your general, what are you observing out of this sector that's just been so beat up over the last, like, I guess you could say a year and a half now? It's just been really tough.
Yeah, I mean, yeah, let's put that into a few different parts. So let's talk gold and silver technicals first. So like the daily time frame, you could still interpret that gold and silver are forming potential bearish flag patterns on the daily chart. Uh, Silver needs to get a weekly close above 24 to, avoid that pattern. And then gold needs to really get above 1940. We've seen gold test 1940 like, I don't know, like 3 times in the last 2 weeks. And it's been, rejected each time that it's gotten up to 1940. So we really need to see gold get above that 1940. The gold miner charts generally look pretty damn ugly. Newmont, also, you could say that's a bear flag forming. Um, and then I put out a blog last week talking about seasonality. I mean, I feel like we are starting to get into the time of year where seasonal tailwinds pick up for the gold miners, but maybe we're not exactly there yet. Might need to wait a few more weeks, maybe till early August. Um, Although I will say this month of the year historically is the strongest month for silver.
Hmm.
We've got a little bounce in silver off the 200-day moving average, but like I said, bigger picture, this could still be interpreted as a bearish pattern that silver is forming. Really needs to break out above that $24 level. As far as the exploration sector goes, sentiment is bleak. Um, it's close to the worst I've seen it. I will say that I am still a bit optimistic. A lot of companies are out in the field doing exploration work, a lot of programs going on right now. I feel like we're going to get some new, discoveries in the sector here this summer. And really, that is the lifeblood of the junior mining sector. It's about exploration. It's about, making wealth where wealth did not exist, previously with a new discovery, in the ground, right? And so I
Mm-hmm.
feel like the sector is really set up for that here in the second half of 2023. And valuations have rarely been lower for most of the sector. And I think that just simply has to do with the fact that the cost of capital has gone up a lot in the last year. And investors are concerned about the prospects of companies having to finance at some point, later in the year. And they'd rather just wait it out, And I think you've brought this up a few times in your podcast in recent weeks that, well, if you can get 5.25% just keeping your money in short term, high yield accounts, then why are you going to take risk in something that you could lose like 50% on in a few
Mm-hmm.
weeks, right? And so I think we're seeing definitely a big shift in investor psychology to being more, adverse to risk. And at the end of the day, the junior mining sector is a risk on sector. We can talk about gold and silver all day long, but at the end of the day, it's a speculative sector that does well when the dollar is weaker, the cost of capital is lower, right?
Right. And something is going to happen that brings or welcomes that capital back into the sector. I mean, there have been a few names out there within exploration and development that continue to see buying. I mean, they're more on kind of the polymetallic copper
Mm-hmm.
precious metal plays that have shown really good drill results and exploration work. And they're few and far between the rest of the market here, Rob. But you just kind of wonder if it's going to be a macro event or even just like a single maybe discovery or massive news event that shows really what incredible wealth generation can come from this sector that brings money back in. Is it going to be one news event from a specific company, a discovery maybe, that really opens the doors back into junior mining? I'm not quite sure. But on the other side, I'm also hearing news from other companies that are closing doors on projects. They've started drill results, they haven't hit what they wanted, and they're taking their capital and saving it until the
Mm.
market improves. So, for as much as good exploration work is happening right now, despite the markets, there are companies out there choosing not to spend the money. So
Yeah, that's a really interesting point. I haven't heard that yet, but it's interesting to hear you say that. And I kind of anticipated that that's probably going to happen at some point here this summer. Companies that maybe are under 2 million in the treasury that have a weak share price, just say, hey, let's pack it up and live to fight another day. We don't want to run the treasury down to zero and have to put a gun to our heads to raise capital, right?
right.
And to be frank, that's what happened in 2015, the summer of 2015, and the sector bottomed 3 or 4 months later and had a fantastic run in the first half of 2016. So hearing that companies are packing it in survival mode, that's a contrarian indicator. It's not a perfect timing indicator, but it sort of lines up with a lot of other things I'm seeing that sentiment is pretty washed out.
Yeah, absolutely. We'll see how this fall plays out into the winter. But Rob, will be touching base again here in the coming weeks.
I'm
So always
heading to the Yukon, Trevor. I'm just going to put
oh
this hat
yes,
on
the
here.
the
Here.
Yukon trip. Oh yes. Our Paul Harris will also be attending.
So
So
we'll talk at some point.
who are you going to be seeing? What's on the schedule, Rob?
I don't know. I think banyan, white gold, fireweed. I think there might be a snowline visit or flyover. Um, yeah, the usual suspects up in the Yukon.
Yeah, absolutely. Well, that'd be fun. We'll probably be reporting, hopefully getting some reports from that trip as well. Rob Sinn, CEO Technician, thanks so much for your time. Safe travels. Appreciate you.
Thank you, Trevor.